Jarrod Kerr, Chief Economist with KiwiBank. How are you?
I'm great. Great. Thanks for having me on the show.
So today we'll talk about property today, and specifically, are we in the eye of the storm, or increasingly, are we in the calm before the storm? I'm not quite sure. Everything around the edges is what we'll frame first. Start from the household, then go to the economy, then talk about the worldwide economy. Does that sound good?
Yeah, sounds great.
So if property is the boat, then the economy is the sea, and the sea is looking a little bit shaky, a little bit rough, a little bit changeable. We can kind of recognize some of the weather patterns, but still we don't know how they're all going to mix together and how the boat will stay afloat. Describe to me some of the themes that are present in the home right now, like inflation, unemployment, all that sort of stuff.
You say sort of choppy seas out there. There's also a few big waves coming through, and that's rising interest rates, which is a global thing. We've seen a whole lot of central banks raising rates. I think about 55 in total are hiking interest rates globally, and they're doing that to try and get inflation down. And we're obviously experiencing, very large increases in prices here in New Zealand. Kiwis are feeling the pinch. They've lost a lot of purchasing power with prices rising the way they have, and those with debt, particularly those in the housing market, are facing much higher interest rates as well. And again, that's a global thing, but it hurts. And I think your point around, are we in the eye of the storm, or is there a lot worse to come? I think we've seen, quite a large decline in house prices already, but it looks like it'll continue for a little while yet. And then I think things will stabilize. And as migration returns, we'll see a bit more demand coming
Sure.
into next year. So house prices, I think, will start rising next year.
Okay, well, let's dig into that a little bit as we go. I'm hearing a lot of stories coming through from people saying they've really observed high fuel costs, higher energy costs, higher insurance costs. Then, separate to that, even though it is a higher cost mortgage cost, a lot of people coming off the cheaper fixed rates that we've seen. And I guess the other thing is employment. It's more likely that people are working really hard inside the home, right? Because if people want to work, they are working right now. Would that be right?
Yeah, our labour market is incredibly tight. The
Mm.
unemployment rate's very, very low. And anecdotes from our customers, but also what we're seeing in business surveys, is it's very hard to get the right labour at the moment, and businesses are screaming out for workers. And it's not just in one or two industries, but it looks like it's across, most industries.
Yeah.
Businesses are really struggling to get the right workers. So there's plenty of demand for labour out there, but the supply is not there. And if anything, it's getting worse with the number of Kiwis wanting to leave and do their OE overseas. So it looks like it's going to get worse before it gets better. And that's really constraining growth in New Zealand. I think we'd have much higher growth if we had more people in the labour force.
And you have recently been doing a lot of speaking engagements around the country, and you've been talking to your customers, which primarily small to medium sized enterprises, which are, I guess, the bulk of employers in New Zealand would fit into that small to medium sized enterprise. How many of them do you feel are just trying to endure the lack of skilled employees versus trying to innovate so that they're not dependent on employment and they move more to technology? Are people investing more in technology to as an offset?
It's an excellent point. You would expect that in a market like the one we've got now, where it's really hard to find workers, that you would see more businesses innovating or buying, better technology or a better machine, or doing more stuff online to try and get around the fact that they can't find the workers. But what we're hearing is there's so many issues going on right now with a huge ramp up in costs for businesses. So a massive ramp up in wages and the cost of labour. From the discussion we've had, it looks like businesses have got their heads down and they're trying to put out the fires that are in front of them, and that willingness to invest. We saw a bit of it last year. We saw businesses ramping up their investment intentions, but this year investment intentions really have dropped off. and businesses, I think they've got their heads down.
Is that partly because of interest rates and credit availability is so restrictive that they can't actually invest in plant and equipment, for example, versus labor, which is a monthly expense that's recurring? Is that part of it?
Yeah, I think it's definitely part of it. It's more expensive to do things. Not only what you want to do is more expensive, but as you say, the access to credit is not as easy as it once was, or even a year ago, particularly with the
Mm.
triple CFA coming through, that has made banks more cautious. So yeah, the availability of credit is an issue, but also just the general rise in costs. So anything you want to do is much more expensive now.
Sticking within the household context, just thinking about maybe there's two people going to work, chances are they are employed by a small to medium sized enterprise, and chances are they're very valued at the moment as an employee. So consequently, feeling secure around the source of income within the household, is that one of the things that is driving household confidence, even though there's significantly rising costs with mortgages and inflation? There's also a lot of confidence around the source of income potentially increasing as well, right?
Yeah, so household confidence is quite mixed at the moment. Like you say, job security, incomes are rising, but the rise in incomes and wages isn't actually meeting the inflation that we've seen. So in real terms, you're still walking backwards. Now that will change over the next year. I think headline inflation is going to decline, and we'll see a meaningful lift in real wages. People
Mm-hmm.
actually taking home more money, and purchasing power
Mm-hmm.
increasing again. But when you look at the consumer confidence survey, it's actually very weak. So even though there's very good job security at the moment, there's a lot of churn in the labour market. So people are actually leaving jobs to get better pay elsewhere. It's a sign of a very tight labour market. Households are also concerned, with very high rates of inflation. The cost of living is obviously a big issue for households. And then on top of that, you've got rising interest rates and falling house prices. And falling house prices really puts a dent in confidence, yeah, particularly those that obviously own a home.
Yeah. And are we seeing a rebalancing occur then? And we're probably skipping ahead to more of the macro themes, but are we seeing a rebalancing occurring in terms of the reward that we can now get from our labor versus the reward that we can get from our capital?
Yeah, yeah, good point. I think the return on capital is clearly an issue, particularly if you're playing around in the housing market. I
Mm.
think people are of the opinion that house prices can continue to fall, so that sort of changes that dynamic quite a lot. And with interest rates rising the way they are, you need much higher return
Mm.
on your capital to justify that. But then again, like you say, your income growth is picking up as well. So we are in
Mm.
a very interesting period. I
Mm.
think the next 6 months or so will be quite awkward for the economy and for households.
Yeah.
But we should fight our way through it and start to see a bit of a recovery next year.
Yeah. Awkward is a really good term for it though, right? Like whenever you're kind of at that apex and you're starting to almost feel like you're in zero gravity and things, you're really disorientated. The reference points are all over the show because we're right at the cusp of a change in so many areas. And yeah, I just wonder though, with that whole dynamic, when interest rates are too low for too long, it really does influence asset prices significantly. And we saw that with property. That was really
Yeah.
clear. It's not right, and by right, I don't mean fair and equitable. I mean, it's just a little bit odd when adjusted for inflation, a house price could make more than the average wage every year in terms of capital gains. That seems a little bit odd. Every now and then, that's fine, but persistently, that doesn't quite make sense. And
Mm.
so I guess that was maybe a sign or a symptom of interest rates that were too low for too long. Would you agree?
Yeah, definitely. I mean, I think the response at the time was right. I mean, we were staring down the barrel of a very large recession. We looked at the pandemic, and large parts of our economy were effectively shut down. And at the time, things things looked very bad. So we saw obviously interest rates slashed, and that had an impact on asset prices, particularly housing. And we saw a massive response from the government as well. And it proved that fiscal policy, when working alongside monetary policy, is really powerful. So I think central banks and governments have learnt from that. And, future recessions, you'll see more coordinated responses.
Mm,
But in hindsight, the length of time and the amount that we did was
mm.
clearly too much, and
Yeah,
for too long. And this is not just New Zealand. I mean, this is a global issue. Every central bank has made the same decisions, and the Reserve Bank of New Zealand, believe it or not, was actually one of the first to
yeah,
start lifting interest rates and unwinding their quantitative easing. But over the last, 6 months, the Fed, the Bank of England, the ECB, like I said, just about every central bank on the planet, excluding the Chinese and the Japanese, have been lifting rates quite aggressively to try and get on top of inflation and mop up that extraordinary stimulus that they threw at the pandemic.
that's right. You mentioned coordination between central banks and government, so coordination of the fiscal response and the monetary response. And I would agree that those two things were absolutely firing too well, right? They were firing too good to help steer us away from what could have been a really, really nasty recession. Now, however, it feels in some ways that there's still a lot of coordination, but it also kind of feels like they're moving in different directions. In that monetary space, we're seeing hiking interest rates to try to mop up that excess liquidity in the system, I guess you could say, mop up that inflation. But at the same time, on the fiscal side, there's still a lot of stimulus going through. Will that mean that we're going to get prolonged inflation if the fiscal side doesn't snap back in line and start to reduce spending?
Yeah, so in New Zealand, the government's trying to be more targeted in their spending. And if you look at the amount of stimulus being generated out of the government, it's actually reducing and starts to contract in the next few years. So fiscal policy is a bit harder to turn around, particularly when you announce big infrastructure spending. So it really is up to monetary policy to try and mop up this situation. And we know that the best way to tackle inflation is to lift interest rates and tighten financial conditions. And I think we'll see that globally, that central banks are taking the lead and doing what they can to reverse things. But it's going to be a massive challenge. Inflation globally is running at 10%. So to pull that back down to 2%, there's a lot of work that needs to be done. And unfortunately, it's going to land on households, right? By design, they're trying to slow down demand. They're trying to crush consumption. And
Correct.
that's the only way they know how.
Yeah, it's the only tool they have at the moment. All right, so just thinking again about the New Zealand economy now, which I presumably is not too different from the 55 other economies in the world where the central banks have been hiking interest rates to combat inflation. It's probably the same sort of thing. We seem to be out in front, leading the charge in so many ways. Many people think we're behind in a lot of ways as well, but I think in some ways we're totally advanced in terms of this cycle. But inflation is a weird one because we can kind of import it. Like there's almost no way that we can hide from it. Can you just explain to us how inflation can be imported? Like what is the mechanism by how that works?
Yeah, so we obviously buy a lot of goods and services from overseas, and the price of those goods have increased quite dramatically. Like I said, global inflation is running at 10%. Our tradables inflation, which is the goods that we import, is running at 8.7%, so very high. The
Right.
outlook for our imported inflation is pretty positive, although we've just experienced quite a decline in our exchange rate, which means those foreign goods are that much more expensive again. But looking at global shipping costs, they're
Mm,
coming off quite dramatically. The pressure in global supply chains has been alleviated. So there's very positive outlook for shipping costs and the time it takes to ship stuff around the
Mm,
world. And global commodity prices, I think, will come under downward pressure over the year ahead because we're going to see a slowdown in global growth. So I think the tradables component, that imported inflation, I think is going to come off quite quickly over the next year. But the focus then turns to the domestically generated inflation, and with wages rising the way they are, and the pressures that we're seeing across many industries in New Zealand, it looks like that domestically generated inflation is going to be quite sticky, and it's
mm,
going to take that much longer to come off. And that's what the Reserve Bank's focused on. We can get a bit of a windfall from falling imported inflation, but that domestically generated stuff is much harder to break, and it's why the Reserve Bank, I think, will remain quite aggressive and hawkish in their actions.
okay. Just thinking about what's contributing towards the inflation that might persist beyond when the supply stuff is kind of stabilizing. How much is the Central Bank of New Zealand, the Reserve Bank of New Zealand, how much are they responsible for the inflation versus the supply side issues that we have?
Yeah, I think it's both contributed quite a lot. On the supply side, we had a supply shock. Obviously, we're still having issues on the supply side of the economy. Labour market's very tight for one reason or not, or another, I should say. And the ability to do what businesses do is being hampered by the fact that we're running at very high levels of capacity. We're sort of bumping up against capacity constraints in many industries. So the supply side has not been fixed, and is still a big cause of inflation. And like you say, the central bank's focusing on what they can control, and that is the demand side. So during COVID, we had this massive spike in spending on goods because we couldn't spend as much on services, during lockdowns and the like. There was a big demand shock higher on that,
Mm,
and the pressure on supply chains for this massive surge in demand for goods globally caused a big spike in inflation. Now
mm,
central banks are trying to pull that demand back down, but we've still got supply side issues. Some of those issues are getting better, particularly shipping costs and
mm,
delivery times and that sort of stuff. That's definitely getting better. But we are going to see, the demand side coming under, much more pressure with
mm.
central banks focused purely on lifting interest rates and really trying to get demand back down to meet supply.
Not that I'm going on a witch hunt here and targeting the central bank unfairly here. I guess I'm trying to understand, going back to March 2020, surely at that time, and everybody says that they would do the same thing if they were the central bank back then, and they were justified based on what was known back then. However, still just trying to think, surely they would have known that with lockdowns, there was going to be issues on the supply side. Surely they would have foreseen that. Yet they were still loading the weapon. They were still pumping more liquidity and decreasing costs. Like mortgage rates were almost, a third cheaper within a few
Mm,
months, and of course that was going to stoke demand everywhere.
mm.
Would you say again that they were justified in taking that stance?
Well, there's always an asymmetric risk, I think, in economics and the economy. And central banks, would much rather face high inflation than deflation, and that was their bias. That was their least regret. And I think, in hindsight, as you point out, they clearly did too much, and we've now got too much inflation. But they would rather this problem than entrenched deflation, which we don't really know how to get out of. If you want to look at Japan as a classic example, so I think they're looking at inflation, which is much higher than they anticipated, but I think that they're somewhat confident in their ability to pull inflation back down, and we will see some very aggressive action until that happens.
Hmm. And going back to that, what you were saying around Japan as an example of why deflation, we don't want to go there. I always have this question asked of me: why is the mandate set around that 2% mark in terms of positive
Mm.
inflation? Why is that the goal? Why can't it be zero? Like, why are they so paranoid of deflation?
Well, deflation is an ugly beast, and it changes your mindset. So it sounds nice to think that prices are just going to continue to fall, across the board, and things are going to get cheaper. And people forget that there are a lot of prices in the economy. There's the price of cars, the price of food, but there's also the price of you as a worker, the price of labor. And in a deflationary world, firms are actually trying to reduce the cost of labor at or at a faster rate than some of the other declining prices, so they can maintain profitability. So you actually end up in a world where you get pay cuts every year rather than pay rises. So deflation is not actually a good situation at all. And why they target 2% rather than 0% is that if you're targeting zero, then you're very close to falling into deflation, right? So they target two. Seems to be a level that most central banks and academics think is about right. There has been arguments for actually lifting it towards three, so you get further away from zero, because we've been so close to zero recently. But that's neither here nor there. With inflation running at 10% globally, there's still a lot of
Hmm.
work to do just to get it back down to three.
There's a lot more in that I'd love to go into, but we'll move on and maybe just zoom out a little bit. So we've started off in the household, we've looked at the New Zealand economy in general, and now zooming out a little bit more, looking at the global economy. We've had a global thing happen with that pandemic that affected the whole world. So naturally, you would expect to see some alignment. And here in New Zealand, we sometimes I've kind of often wrestled with the idea of whether or not the central bank, the Reserve Bank of New Zealand, and our government is too close, working too much in tandem. But also, when you zoom out and you look globally, I guess that's also the concern, is that our central banks operating too much in tandem. And obviously, based on what we've seen, they kind of have to. But do you see a risk in that? Do you see a risk that globally we're going to be too much in lockstep with the US Fed, for example?
We've always been, driven a lot by the US Fed, particularly other countries that may have fixed exchange rates, or debt in US dollars. So the Fed really is the supplier of US dollars, which is the most dominant currency globally. So Fed policy is probably one of the most influential globally. Not only is it managing the US economy, but it has significant impacts on other economies as well. There is no doubt that, like you say, with quantitative easing, that central banks have moved closer to governments. But what we're seeing now is an unwind in quantitative easing. So we're going through what they call quantitative tightening, and that is, first of all, stopping the purchase of government bonds, and then actually letting those bonds roll off, or in some cases, like New Zealand, actually selling government bonds back to the market. But there's no doubt that central banks and governments have moved closer together, become a lot more aligned to deal with this pandemic. And thank goodness they did. To be honest, that really did propel us out of this pandemic. But the argument is now, they propelled us a little bit too much, a little bit too far for too
Yeah,
long.
yeah, that's right. Out of the frying pan into the fire type thing, right?
Yeah, yeah, yeah.
So staying in that theme around the Fed, a lot of people have probably, a lot of investors specifically, have kind of been looking at the Fed as the backstop. They've always got the Fed put in place. So they know that if things get scary, there's always a buyer of last resort, and that'll underpin the market. Therefore, it creates this moral hazard situation where they don't need to worry about risk anymore. And to a certain extent, that feels kind of like a repeat. But as time goes on, there's this new narrative that seems to have formed, which is no, the US Fed won't step in. They will actually keep hiking rates and they're not going to stop. So here we have this situation where there's a game of chicken, and some investors, this is more in the equity space rather than property, but we'll come back to property in a second. They're starting to realize actually, maybe no, they are serious. So on
Mm.
the equity side, share markets, which ultimately affects our managed funds, superannuation, KiwiSaver, what do you think, Jarrod? Are we going to see significant declines in share markets as the Fed just keeps on going with this hawkish stance?
Yeah. So just to start off, we've had quite an interesting uh, start to the year and continuation to today, where portfolios have been hit on both sides. So you hear a lot about the 60-40 portfolio. So you're 60% equities and 40% bonds. And the idea is that if equities fall, bonds are going to increase in value, and vice versa. So, you're balanced and somewhat balanced as a portfolio. But what we've actually seen is interest rates have increased, which means the value of bonds have gone down. So you're losing money on that 40%. And
Mm,
equities, as a result of much higher interest rates and a weakening growth outlook, are also falling. So
mm,
portfolios have been hit quite hard, and on both sides.
mm,
That, I think, continues. We are going to see interest rates continuing to lift. Uh, Central banks, including the Fed, are very aggressive. And it was just the other day that the Fed announced another big 75 basis point hike in their cash rate. And they're telling us that there's going to be another 125 basis points worth of hikes this year, and that they're going to take their cash rate to 4.6%, which is very high by their standards, and maybe even higher than what the Reserve Bank of New Zealand gets to. So, that one side is going to continue. Interest rates are going to keep lifting. And then when you look at equities and you're trying to value what a stock is and what price it should be trading at, you're looking at future earnings, future cash flows, and you're discounting them back using
mm,
an interest rate to get a present value. And you're forced to now use a much higher interest rate, so that current valuation is lower. And I do think equity markets are going to be quite choppy at best for the rest of the year, simply because central banks are tackling an inflation problem that's probably going to take a year or longer to actually get on top of. So, yes, financial markets are going to, I think, continue what we've seen, particularly over the last 6 months.
yeah, and one of the reasons why it's so, I guess, volatile is that you can see everything. There's a lot of liquidity. There's a lot of transactions happening, so you can see the market responding to the Fed's call instantly. Whereas on the property side, and just bringing it back to New Zealand, typical households thinking about their property value, there's a wealth effect that goes on when people feel wealthy, and when they don't feel wealthy, that has the inverse effect. It's less liquid. There's a less transactions. There's less price transparency. So we don't know, but it would be pretty safe to say then, by extension, that what we see happening in the equity space, we're probably also going to see in the property space, right?
Yeah, yeah, I think we are seeing it in the
Mm,
property space. We are seeing house prices falling in New Zealand, but also in other countries as well, right? House prices are falling in Australia. I think they're about 6 months behind
mm,
us in that cycle, and I think house prices will continue to fall. I think we're off about 8% from the highs of last year, and we think we'll see a correction of around 13 to 15% this year. So it sounds pretty meaningful, and like quite a correction, and it is, but it follows rampant price growth up until the end of last year. I mean, just in the year to August, I think last year we saw house prices up 33%, which is just staggering for a housing market to make those sorts of gains. So with a 15% correction down, house prices are basically going back to where they were in early 2021. So people have been in the game for longer than the last couple of years. There's significant equity in people's homes, significant equity in people's homes. But the main thing uh, hurting households who own their own home is clearly the interest expense is rising quite rapidly.
Yeah.
Interest rates have obviously more than doubled in the last year,
Yeah.
and most people who have a mortgage are rolling off in the next 6 months. So they're rolling off those, really attractive rates,
Yeah.
record low rates of last year, onto
Yes.
something much higher now.
And that's the thing, right? So it's thinking about what's happening globally with rising Fed rate and rising OCR, official cash rate here in New Zealand, that affects mortgage rates. Yes, property values do decline as a result of that. Those two are absolutely linked, but that's not the real issue. Like what you're saying, the real issue with households is the rising interest costs. So, on the topic of interest rates, let alone what happens with property prices, but with the cost of money, because we're so indebted, what can you tell me about the yield curve and talking about the yield curve? Like, there's a lot of different types of yield curves that we could talk about, but maybe just to define that for us. Firstly, what do we mean when we're talking about a yield curve here?
Yeah, so it's interest rates across time. So we have an overnight rate, which the Reserve Bank sets, and that's the official cash rate. That's just an overnight rate that the banks deal with the central bank on. And then there's an interest rate for 1 year worth of lending, or 5 years worth of lending, or 10, 20, 50 years. Yield curve goes out quite far depending on the country that you're in.
Yeah.
And normally it's upward sloping. So, you lend money for short term, there's much less risk in that than there is, lending money for 30 years. So you should demand, a higher interest rate for a 30-year loan as opposed to a
Mm.
1-year loan, just on the risk alone, associated with that lending. So it's
Mm.
normally upward sloping. So a 30-year interest rate should be significantly higher than a 1-year interest rate.
Mm.
What we're seeing at the moment, though, is one of these rare occasions where a interest rate curve, a yield curve, is inverted. And what that means is short-term interest rates for 1, 2, 3 years are higher than 10-year, 30-year interest rates. And that's quite unusual. And what it shows is that there is a lot of tightening coming through. There's a lot of interest rate increases coming through from central banks, now, and that's
Hmm.
being priced into these shorter interest rates. And then markets look at that and think, well, there's a lot of tightening coming through, therefore growth and inflation and even term premium are,
Mm.
are lower because they're expecting a slowdown in growth and a slowdown in inflation. And you get this inverted yield curve. And historically, a inverted yield curve does point to a significant slowdown and in many occasions a recession. And it is a signal in financial markets that at a very minimum, things are going to get worse economically because of the interest rate increases coming through.
Right. And this isn't the first time that I remember seeing this. Like I think it was 2006, 2007, we saw that the longer term fixed rate, specifically the 5 year rate, I remember looking at that. I think it was around 9.75. So this is back 06, 07, probably tail end of '07, actually. 9.75 on a 5 year rate. That actually looked good because the floating and the 1 year rate were higher than that. And so that
Mm.
was a really classic example, I guess, of a negative yield curve in the context of mortgage rates. And even just yesterday and today, I've seen banks here in New Zealand crank up the short term rates. And pretty soon, I'm kind of speculating now that you can have whatever interest rate you want as a mortgage holder, as long as it's 6%. Do you kind of see that we're probably going to be flattening and then maybe inverting on mortgage rates soon?
Yeah, it's definitely a risk. I definitely agree with you on that flattening. So the 1, 2 year, even 3 year mortgage rates rising, faster than 4 and 5 years. But those 4 and 5 year rates are actually quite high already. So I do see that flattening taking place. As you say, will it invert? I'm not sure. I don't think we've seen enough of an inversion in the wholesale rates for that to be
Sure.
fully reflected in retail rates. But the main message here is I think mortgage rates are getting close to a peak, but like you say, there's more flattening coming. Those shorter term rates, particularly variable rates, have got a lot more to
Mm.
move upwards as the central bank lifts the cash rate further.
That's probably one of the glimmering signs of hope in a way for the household, going back to the household as well. Just thinking about where mortgage rates could go is that at some stage, the market might stop believing, I guess, the Fed and the Reserve Bank, and they might start to price in significantly lower interest rates to come. But as that happens, just thinking this through, I guess that lowers the effectiveness of the OCR as a tool to combat inflation as well, doesn't it?
Yeah, so if you think back just a few months ago, the central bank came out with a very hawkish commentary saying they want to tighten to 4%. That was already priced in to the market, and we actually saw wholesale rates decline, and there was a period there where banks actually lowered
Yeah,
their mortgage rates, and that was taken into account by the central bank, and they actually added another rate rise to their forecasts. So the the less uh, reaction in wholesale rates and mortgage rates, the more the central bank feels they'll need to do
right.
to beat inflation. So it is a feedback loop, if you like. So
Yeah,
if mortgage rates rise, well, the central bank would say, well, that's helpful. That's doing the job for us. When they
yeah,
look at interest rates, they're not necessarily looking just at wholesale rates. They very much focus on retail rates, what actual mortgage rates are doing
right.
in the economy. I personally think that we're getting to levels where mortgage rates are likely to peak. We've already got the Reserve Bank's path factored into wholesale rates. So the risk is definitely that the Reserve Bank has to do more and that mortgage rates can rise further. But I think we're getting near that level where they've got enough traction, and I think mortgage rates, could easily be peaking here. And if we wake up this time next year and inflation's running at 3%, the the housing market and the economy have cooled quite a lot, then the next move is obviously rate cuts, and that could occur in the second half of next year or into 2024. So your point around the evolution of mortgage rates from here, risk is potentially to the high side from here, a little bit more increase, but then I would reckon I would think hope that this time next year it's probably the reverse. You might start seeing those mortgage rates falling as expectations of rate cuts come through, but we're still a long way away from that, and we've got to see inflation fall quite substantially before we're in that position.
Right. Okay. So basically, what you're kind of saying then is that more or less we've peaked out in terms of where fixed interest rates are going across the board. Is that what you're saying?
Yeah, close to.
Mm.
Based on market pricing, and if the RBNZ only goes to 4.25, then a
Yeah.
lot of that is priced in, and I think mortgage rates, wouldn't move much from where we currently are.
Yeah.
Obviously, if inflation's worse than expected, higher than expected, then the central bank just keeps hiking, and mortgage rates can keep going.
Yeah.
Um, if we get things under control, which is in our forecasts, then the next move, sometime next year, is going to be, a fall, an expected fall in
Yeah.
interest rates.
Because ultimately we have to shrink, right? We have to pull back. We have to degrowth. We have to take our medicine. We have to shrink. And when you have high cash reserves and there's two people working in the household and your mortgage is fixed for 4 more years on a really attractive rate, well, that means that you're not contributing towards the solution. You're actually making it worse for the whole country, right? So we should all just get on with it and act poor. Is that probably what we should just pretend to do?
That's an interesting way of thinking about things. I think that the main thing I would say is we're in a very awkward position. The central bank thinks that it's in a position where their very credibility, their credibility as a central bank is being questioned because their mandate is primarily on inflation, and inflation's miles away from their target. So they're not meeting their mandate. Their credibility as a central bank and other central banks around the world is being tested. So they're going to be very aggressive, and I think they're already getting significant traction with their interest rate increases so far. That we're already going to see quite a substantial slowdown in growth, and you can see that in the last GDP report that we had, with household spending down on the quarter, and I think household spending is already been hurt, and clearly the property market is also contributing to that. So I think they've already got a lot of traction in what they're doing, and I hope we're in a position sometime next year where we can start unwinding a lot of this tightening.
Yeah. And I think that it's kind of a good news story in a way too, isn't it? Because the fact that interest rates can increase this much, which is beyond what I thought they would, to be honest, the fact that that can occur means that we're resilient enough. And the fact that they're determined to do this should also give us confidence in the financial system that the powers that be are doing everything they can to ensure that it works in a similar way that it used to in the past, which should, as investors, give us a lot of confidence knowing that the investment moves that we make today are still going to be boosted by the way that the financial system works, which is over the long term, if you keep on tucking away a little bit more money, you're going to do well. As we come in for a landing here, Jarrod, I'm still left with a sense of optimism. It feels like you are as well, providing we can endure what's coming. What kind of final thoughts would you like to leave us with here?
Yeah, I think you're absolutely right in saying that the financial system is in good shape, and it really is. Banks are in a very good position. A lot more capital is being held these days. Household balance sheets are very strong. Rising incomes, rising savings we've seen, and also a lot of equity in people's homes. What we don't want to see, and what we're not forecasting, but is always a risk, is unemployment.
Mm,
We've got very low unemployment at the moment. Provided unemployment stays low, we can fight our way through this. And households will fight their way through this because they've got a job and they're actually getting more pay. What
mm,
really stresses financial markets, banks, the whole economy, is when something happens economically and you see a sharp increase in unemployment, and that's when things get really ugly. You see unemployment go from 3 to 5%. That's not a massive deal, but you see unemployment go from 5 to 8 to
mm,
10, and that's when you start seeing a significant lift in defaults,
mm.
and an even greater contraction in the property market. So the fact that our labour market is so strong right now, and it is in the US and it is in Australia and a lot of other countries, to me that really is a pillar of support in the current environment.
Yeah, that's a good point to leave it on. Well, thank you very much, Jarrod, Chief Economist at KiwiBank. Thanks for joining us today. Really appreciate your time.
Thank you.
All right, take care.